Hello, welcome back to Learn Oikonomia. Today we are going to discuss the concept of compensatory fiscal policy. What is the meaning of compensatory fiscal policy and what are its implications? Let's have a discussion into these in this particular section. So let's get started for the same. We can say that compensatory fiscal policy plays a very important role in establishing stability of the economy. In that sense, what can it be? Here, compensatory fiscal policy involves a set of measures taken by the government of a country so as to deal with the fluctuations in the economy. So, the government could find that sometimes the economy goes through recession, sometimes there would be inflation in the economy. So, whether it is recession and whether it is inflation, what happens is that we are talking about fluctuations and we are talking about instability. So, as far as business cycles are concerned, we know that there have been many phases in a business cycle. There would be boom and depression, which would be the extreme phases. The topmost and the bottommost extreme phases in business cycles. In between, you do have recession as well as recovery phases. But what would happen if the economy fluctuates too much? And that too, if it happens in a less span of time, it is not identified to be a good sign for a good economy. So, what the government here can do is, the government would be utilizing or it would be making use of certain tools. And since here we are dealing with fiscal policy, the two main tools or instruments used by the government would be expenditure and tax. So, that means the government spending would be regulated and tax would be regulated. Tax would be increased or reduced and expenditure would also be increased or reduced depending upon the situation. So, the government would be utilizing changes in its spending and taxation policies so as to offset the adverse effects that we can have in the economy as a result of economic swings or fluctuations. So, let's have more details for compensatory fiscal policy. The main intention here is to ensure stability. So, what will happen when you have more stable economy? That will ensure that you are ensuring a sustainable economy. Why? Because you are having an economy and economic growth or whatever possible happenings in the economy right now would be there as it is. Along with that, you are caring for the future needs. So, the economy would be used not only by your present generation, but also it would be used by the future generation. So, when that time comes, the economy should be with minimum shocks. So, what the government can do is that the government would be adjusting its tax and expenditure patterns so as to deal with the economic shocks or fluctuations or swings. During the times of recession, you know that the aggregate demand of the economy would be falling and unemployment would be rising. So, recessionary phase means there would be a dullness everywhere. Thus, what happens? People won't be having enough money with them, and for the very same reason, they will be demanding less. So, their demand is coming down, the aggregate expenditure would be coming down and unemployment would be rising. So, just go back and remember what happened during a COVID period. So, the COVID period was showing us one of the closest example of something that would be happening in a recession. And also you can think about the 2008 crisis, 2008 financial crisis. So what happened? The unemployment scenario was rising, as well as the income in the hands of people were, this was falling, and for the very same reason their demand was falling. So here the main intention of the government is to ensure that people are demanding. The government want to pump some money into the hands of people so as to increase the aggregate demand. So what can the government be doing here? It will try to stimulate the economic activity. So in order to stimulate its activities, the government would be increasing its spending. So what happens? The government would be increasing its spending on infrastructural projects. It will be increasing its spending in the form of pensions, social welfare programs, other kind of social welfare programs. So some grants would be given to the people, subsidies would be given to the people, unemployment benefits would be given. The main intention here is to ensure that people are demanding. Thus, what happened? As a result of increased government spending, aggregate demand would slowly be increasing. Because there is money in the hands of people right now as a result of increased spending by the government. So income in the hands of people is increasing now, and for the very same reason they could now use the increased income to purchase some commodities from the market. So the aggregate demand would be increasing, and definitely people might be investing some money somewhere, and they would be going for self-employment, and they might also engage the labor services of somebody else. Thus unemployment scenario too would be coming down. But on the other hand, what can we have during inflationary periods? During inflationary periods, the opposite scenario will be coming. So what happens here? Here the aggregate demand is more. When you compare aggregate demand and aggregate supply, you can find that aggregate demand is more than aggregate supply. So the government would find that people are having some excess money in their hand. In such a scenario, the government would be trying to cool down the economy by putting a control on the money flow to the hands of people. And how can this be happening? The government would be increasing taxes. Earlier the government was reducing taxes. During a recessionary phase, along with increased spending, the government would be reducing taxes, and here the government would be increasing taxes. So what happened? As a result of increased tax, the disposable income on the hand of people would be coming down. A disposable income means income after tax. So this would be coming down, and thus you can find that the income in the hands of people would be coming down, and thus their demand too would be coming down, and here the government would be reducing its spending. The expenditure policy of the government would be such a way to reduce its spending. So we need to understand that as far as compensatory fiscal policy is concerned, it has got several aspects to be considered, and it has got many benefits too. The basic benefit that we can have here is stabilization effect, because it would be stabilizing the economic cycle, or it would be stabilizing the economy. It would be fighting against the fluctuations that we have in the business cycle. So it would be countering the negative impact that would be creating as a result of recessions, inflations, etc., and ensure that there is sustainable growth over time. So our economy would be an economy in that case which would be facilitating investment. Why? Because when a particular economy, or when our economy goes for compensatory fiscal policy, it would be facilitating investment by arranging and adjusting with the requirements of the economy so as to give some confidence to the prospective investors. It will also give some confidence to the consumer. It will also give employment opportunities to the unemployed. So, also it will be going for, or it will be assisting our government to go for judicious use of resources without any wastage. The government will be spending for whatever needed, and it will be reducing its spending for unwanted requirements. It will promote social welfare, it will be reducing inequality. Definitely, here it will deal with the immediate shocks. So, such a kind of fiscal policy would be very much required for the economy. Thus, we are not thinking on short-term lines. Instead, we are having a long-term perspective when we talk about compensatory fiscal policy. And the government would be spending too much for education, infrastructure, research, etc., especially during the time of recession. Because the government knows it very well that it's very much important to enhance the confidence of people. Otherwise, what happens is that it will be leading to a depression, like what happened during 1930s. During 1930s, we couldn't understand the role of the government. The classical economists were always giving emphasis to the market forces, and they were not identifying the role of the government. They always believed in the non-intervention of the government, and that all had created a huge crisis in the world called the Great Depression of 1930s. And later come Keynes, who told that we have to give appropriate importance to our government, because government plays a very important role in reviving the economy out of the crisis. And thus it happened, we could come out of the crisis with government intervention. So, effective policy design would be demand some forecasting also. So, what does it mean by forecasting? We require some predictions. And how can you do some predictions? We can use available data and go for predictions. Again, that involves too much of complexities and complications. And also, some timely intervention by the government is very much involved and required to deal with desired outcomes. If you think that you need some desired outcomes, it's very much important to ensure that there exists a government which goes for compensatory fiscal policy and which goes for judicious use of resources, which avoids wastage of resources, and it thus goes for desired outcomes and avoids unintended bad consequences. So, the compensatory fiscal policy would be depending on so many factors. First of all, the government should have sufficient resources. When I say resources here, financial resources plays a very important role. Definitely other resources would be coming into picture here, but mostly financial resources plays a role because the government is managing the flow of money to the hands of people here. So, excessive reliance on borrowing. This will be again leading to unsustainable debt. What will happen here? Just assume that now we are having a recession. So, and the government is not having enough money with it. It might go for borrowing to spend more today. And borrowing means the government is borrowing today and tomorrow it has to pay back. And when it pays back the debt, it might be charging a high interest rate. So the future generation would be suffering here. The future generation might be pushed to a crisis. So we do not require that. We need to ensure that our government is managing its financial resources in an appropriate manner. So, altogether we could find that this has been a very important tool. Compensatory fiscal policy plays a very important role which involves the government to adjust its taxation and expenditure policies to deal with the fluctuations in the economy, and it would be addressing some problems in the economy like income inequality, lack of sustainable growth, etc. So what we have to consider here is that we need to first of all study the present scenario of the economy, then only we can go for appropriate policies. So understanding of the present scenario of the economy is very much important, and for this you require careful analysis. So you can use data collection, empirical evidence. This is very important, and later you can use this empirical evidence so as to go for more forecasting, and thus you will be not like controlling the economy, or the government is not like controlling the economy, but instead it would be managing and monitoring the economy, and it would be taking appropriate policy at the time of requirement. So that is all about compensatory fiscal policy. Thank you for watching. You can like, share and subscribe to our channel for more videos. Also, you can join our free Telegram community. I'll be providing the link of the same in the description box. Also, you can download the Learn Oikonomia app, for which also I'll be providing the link in the description box. That's it. Thank you for watching.